Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. I am so honored to have as one of my early guests to The Debt Doctor a friend who I've been trying to get on previous webinars, podcasts, and whatnot. And the last time I saw her, she's a brilliant attorney. And you know, I have a thing for attorneys. The last time I saw her, she was at one of the great firms in the country. And now she's at one of the other great firms in the country. And I will introduce Wendy in just a moment. But this episode today is going to be about enforcement. That's the conversation. Wendy works for Logs Legal Group. And if you are, like me, an investor in the mortgage space at any time over the last 2 decades, then there's very little chance that you haven't had Logs work for you on a file, most likely. I mean, at least if you bought any scale. That you guys are in states all over the country. Maybe you can give me give everyone a little rundown. I know this firm as Shapiro Fishman because I'm from Florida originally. That would just happen to be where they founded this great organization, and obviously, I want to send. We also have to send a shout out, love to my good friend Jason Shapiro. Tell us about a little bit about Logs, a little bit about you. Introduce yourself, and then we can get into the gossip.
Sure thing. Awesome. Well, thanks, Bill. Thanks for having me. I'm really excited. I've been a huge fan of your podcast. I love the way you educate. I think the first time we met was American Catalyst. You had this awesome book. I remember reading through the book and then seeing it like on DS News. And it's great. The education is really important, I think, for anybody that's in this space, whether you're
100%.
an investor, originator, servicer, or you're handling the default side of the equation. And in your last week podcast, I think you discussed that you're the debt doctor and then you need the scalpel, the person that actually goes in and enforces. Logs Legal
Boom.
Group, essentially, we're just a group of scalpels that operate, that are licensed to do business. Our entire firm and enterprise is in 32 states and growing. We're pretty focused on the areas of anything having to do with mortgage. We handle residential, we handle commercial. I just joined the firm at the beginning of May, and I am helping in all states across the country to help modernize a little bit of digital transformation and grow our bench of strength in resi and commercial. So it's been a really exciting, 30 plus 12 days, 42 days so far.
I mean, Buckhalter was a premier firm. You were doing non-mortgage there. Or you were you come from multiple paths of legal, right?
So Buckhalter, I was the chair of the AI and FinTech group, but I really focused on the fin, which is the financial and the lending aspect. So I had clients that were doing commercial, ground up construction lending, DSCR lending, helping them with all aspects of their lending, from their compliance origination processes, their licensing, to their MLPAs, to supporting issues that came up with funds, to helping them with loan sales, to helping them with the scalpel elements of
Mm-hmm.
came up because not every project goes off according to Hoyle. And then I also had a tech background. So I was supporting a lot of tech initiatives and technology, contracts, data privacy, information security, data breach class action support, you name it. I had a very broad kind of range at Buchalter, which is a great
Mhm.
firm. I still remain friends with all my partners there and shareholders there. But this logs opportunity was a really great chance to work with a great group of humans in a space that I know very, very well. So
Yeah, I mean it's just like so amazing how the universe works, you know. And Logs now does more than just mortgages because there's a lot of asset backed type enforcement and collection that can be done, and I think you guys are getting into autos pretty big too, right?
absolutely. Yeah, we're doing all types of debt really. In the enforcement stage, from loan workouts into the actual nitty-gritty collection and asset recovery, secured and unsecured. Our collections group is growing pretty rapidly right now, which I think is part of what you've been observing certainly, and many others are observing. So we do have that. We have litigation, we have appellate work, we do replevins, and there's title and closing elements in our practice as well.
So teach the world because we like to have the broad range of, just getting definitions out there. I love the word replevins. Please tell the average person what that means.
Well, a replevin is an action to recover more personal property. So foreclosure is usually associated with the foreclosure of real property. Replevins apply to certain asset classes of what is considered personal property. Examples being, I think the first replevin case I ever dealt with was like boats, like fancy yachts.
Mm.
And that was fun. Automobiles, so cars, recovery on that kind of debt, manufactured housing, and collateral that doesn't fit, that is not completely tied to the ground, essentially.
Hmm. And you actually, on top of going after them legally in order to enforce that, you actually have the network to go out and collect, like, like the way I don't know if it's like the TV shows, but they send someone out to like steal the car back or the boat.
There's this element of self-help that's allowed in certain states where lenders can actually take certain action,
Yeah.
if they don't want to go through the overall legal process. It's usually advised that you look carefully at the state law, that you don't violate that state law, and that you have counsel kind of guiding you, but there's a certain amount of action that you like to take. But generally speaking, we like to cradle to grave with our clients when appropriate, when it makes sense, and see things all the way through to the actual recovery of the asset if that's needed, from the law firm side.
Are you seeing Are you usually dealing mostly these days with the original lender of whatever loan you're enforcing, or are you finding that more of your clients are buying from other originators and having to deal with problems after the fact, either buying them in NPL or buying them as originated performing, and now they're going bad? I don't know if
I'm
that's.
seeing a mix, like absolutely the full range. Given how long our firm's been in the space, given kind of the size and scope of our operations, I'm seeing NPL that's been purchased and servicers that are going down the chain. Messy files that have been around for a long time, debt and default pre-COVID, and investors, multiple chains of investors that have sold, multiple NPL sales actually. So we'll often get an ask from an investor that's trying to feed back to another investor. It can be complicated. So I would say a mix. I don't have any data offhand to say if it's 50-50 or what percentage it is, but we're seeing, both NPL servicers, default servicers in our portfolio, as well as, originators who want to do it themselves.
Yeah. And do you think is there any group that you're seeing more business from? Is it the than others? Like, are is it single family rental guys trying to evict people, or is it just is it again just kind of a broad mix or commercial? I
Yeah.
don't know.
So I think our footprint is real heavy in residential foreclosure. And so the bulk of our business is in the pure foreclosure space, and then bankruptcy sometimes comes into it. Evictions, is building back up, but has definitely, suffered a decline due to the COVID, restrictions and just
Yeah.
the general.
Yeah, yeah. I was just thinking about that, Wendy, because this is a conversation I probably should be having with Jason, but I know he would never come on and talk about this on the podcast. But it's like you guys were when you're a big national firm and then the nation shuts down the foreclosures, which is what happened in COVID. It made hard decisions had to be made on a nationwide basis, and it's a miracle, the strong, healthy firms that were able to recover and still, maintain market share, continue to serve their clients efficiently. And, it's going to really pay off, I think, for you guys in the near term.
Yeah,
Any
it's
comment in that
hard.
regard?
Well, so I wasn't at logs when, in 2020, I actually was started the Pacific Northwest practice for a firm called MRLP. And it was the pretty dark times, very, very lean, required diversification going into, commercial. There was still more activity possible because there wasn't federal policy protecting commercial lenders necessarily. The lines got blurred depending on which jurisdiction you were in. And I was practicing in the state of Washington, the city of Seattle specifically.
Mm.
um you're absolutely correct. It was the firms that were the strongest, that were the most dug in, that had capital to come in and rescue and stave off the long policy, um the anti-enforcement policies of the prior
Right.
administration. You know it it required a lot of strength and grit for sure, and this firm has survived through that, which I think is a testament to ownership, leadership, and the conviction in the space. And now the name of the game is diversification for future survivals. I mean, we don't know how long administrative policy is going to change. We see that there's a lot more debt that's being, folks are incurring a lot more debt. If you look at data and the, student loan, the lack of forbearance on student loans is going to impact a lot of first-time home buyers that were able to capitalize on those nice low rates, early in the pandemic, and now all of a sudden, they're going to have an additional payment that they weren't anticipating, and that's going to have some pretty big fallout. Um, but the policies right now are starting to be a little bit more rational, in my opinion. Just, I think, a healthy economy, there's always going to be a certain amount of enforcement needed due to death, divorce, life changes, for choices around, your debt, and certainly student loan debt, which is non-dischargeable in a bankruptcy right now, is going to have an impact.
But since we're in the topic of enforcement and you speaking, hopefully, I know you're not speaking for the whole industry, but in this case, you are, in the sense that, like, what's obviously, if I'm a lender, if I'm a bank, if I'm a credit union, having a outside firm that specializes in this, that's a no-brainer. If I'm possibly looking down the barrel of facing you as your plaintiff attorney and I'm the borrower, if there is a sponsor out there who's listening to this, who just got served with a notice of default, with maybe from one of your firms, and do you have any comment, any message for that person? Is there, I mean, obviously you have to say get an attorney. We know that. But, like, is there anything, like, hey, we're open to having conversations, or do you find yourself having to just run the mill, like, by the book, take people to court, or is there really, like, with this next era going to be an openness to having conversations in the judgment phase?
So it depends on the debt. It depends on where it came from. In the resi space, a lot of lost mit has happened over the last 5 years. So much lost mit where I think folks don't have the equity that they used to give them the leverage that they need because they were, accessing certain programs that were dipping into that equity, partial claims being, one solution that was used over and over and over again that really I was listening to a webinar last week. The ALFN put together a great webinar on the partial claim process. And I think it was Darren Bloomquist from auction.com threw up some really great graphs to show how little equity there is left in a lot of residential dwellings because of the excessive loss mitigation band-aids that kept being placed on folks that are probably not going to be able to write out of it. So an individual borrower needs to look at their circumstance and see, like, is there equity to be saved? Do I have the ability to, service this debt in any way, shape, or form? Those conversations are largely, off the table if they've had multiple bites of the apple and they don't have much to preserve. In the commercial space, I'm seeing more openness to discuss workouts. The lenders and their capital partners are more interested in seeing what's possible. I think the NPL market there isn't necessarily as strong. They're not going to be able to deal with the impacts on their balance sheet of those defaults. So getting creative around solutions makes sense. But those are typical, more like commercial borrowers who, if they're builders or doing kind of rehab, fix and flip, that need to be honest about what's going on and finding the right way to move their projects forward.
Yeah, more sophisticated borrowers in the commercial space, yeah, on average, not it as a whole. As a matter of fact, one of the things that I found very interesting, I just learned in the last 6 months, is that of commercial low balance mortgage properties, so I'm thinking properties of 10 million or less of value, greater than 70% of the ownership of that is either single member LLCs or individuals. It's not an institutional game. So you do get a lot of everyday people. A doctor that bought a medical office building and has six other doctors as tenants. A fireman who, he had single family rentals. Now he graduated to a 12 unit multifamily and he got a low interest mortgage 6 years ago and it's up for maturity refi and the numbers don't make sense anymore. So there's a lot of dislocation that I see or I'm seeing right now, and I think there's that the commercial real estate market or any kind of even residential for for rent, any kind of residential performing investment property has gotten repriced with the rise in interest rates. Therefore, a lowering of cap or a higher expectation of cap for for other buyers. So like the whole thing is, I mean, I think set up to be a perfect storm, not to be too dramatic. But any thoughts?
So I mean, you can read into my career moves based on my thoughts, right? I came from a full service business law firm with a great practice, with a great group of partners, a lot of growth in that firm, doing amazing things there.
Yeah.
Pivoting into this space, which is really focused on non-performing assets. So that's kind of where I'm thinking things might be going. Yeah, I think when you look at real estate long term, which is the best way to look at situations, and having gone through, the prior GFC, the great financial or foreclosure crisis, depending on how you
You,
like to use
you're
that.
right. You were
Um,
too young for that, Wendy. Let's admit.
no,
You were
well, I
like
was at
in,
Washington Mutual all the way up until 2008, the very end of 2008. And I helped grow a firm from, 4 states to 17 states that was 100% focused on that, saw the flood of inbound, lender requests to enforce and pull out scalpels all over the country. But it's funny, the amount of loss that was incurred by people that couldn't see through the long term versus riding out through those dips. But you have to have a borrower that's able to do some kind of debt service, and that's the key. And knowing when it's like, we just can't make this happen anymore. We don't have the energy, the business plan, the stamina, or as an individual, serious, significant financial changes in their life. you've got to make that move. You've got to go through that transaction. And the less fighting that occurs over that transaction, generally, the better it is for all parties. Um,
Sure.
but there's a lot of consumer friendly laws that are still in the books. So despite like the CFPB being really gutted, decimated,
Yeah.
really attacked by this current administration for in some reasons, you could see why it would happen. I think an
Right.
agency like that got a little bit too extreme, a little bit too over its skis. There had to be some kind of a pendulum swing back, but this direction is pretty extreme. But there's still a lot of book laws on the book at the federal level, at the state level, that we have to be cognizant of and deal with those challenges when they emerge. And you know, really, if it comes into a court, what that judge is going to, how they're going to view the parties relative to each other. And often you do much better in court if you can say, Your Honor, we've been in workout talks for 2+ years. There is no solution here outside of granting our, request for foreclosure or allowing this, transaction to occur. That's usually the best position to be in. So if I have a lender that just wants to blow through all of that, go right to that finish line, when you get in front of a judge, chances are they're going to ask you to go back to the well and have discussions. And it's a different point of leverage and a different
Right.
that you have to accommodate there.
So better to nip that one in the bud.
Absolutely.
It's interesting. So we haven't talked yet about I mean, so many changes for you. You moved from Seattle to Park City. Are you a skier? What's the deal?
I
I'm
am.
allowed
Yeah.
to tell people where you live, right?
Oh, well, it's out now.
Oops, too late.
Yeah, it's yeah, I am a skier. I moved to Seattle in the year 2000 during the .com like about to crash. It was right on the edge of that. I love the innovation in Seattle. It was a really great place to start to go to law school, to start my
Yep.
practice, to have children, to have a family. But now that my kids don't need me anymore and I get to pick where on the planet I wanted to live, I had started coming to Park City quite a bit and bought a ski condo and decided I didn't want to leave last winter. I just had such a fun time. There's a lot of
Wonderful.
innovation that's happening in the Salt Lake area too that reminds me a lot about those early days in Seattle. And Seattle's got a thriving community of
Oh
technology.
yeah.
Lending, not so much. I mean, Washington Mutual was a large force. There are some regional banks that are there, but Salt Lake City has, a lot of interesting lending, potential clients, and just a vibrance about it, and a no nonsense focus on the future that is really important from a regulatory standpoint. So I picked it for a variety of reasons, and I'm a month in, and I'm really enjoying not seeing rain all the time. So.
That is so awesome. Well, I haven't been to Park City since 1999 when I was there. I had a film called Atomic Tabasco in the Sundance Film Festival. And we ended up getting a cool little, I think we got like an honorable mention also there. So it was a great experience, and I've have friends that go all the time. So I'm gonna have to pay you a visit at some point.
Absolutely. Unfortunately, Sundance will not be here. I think
That's right.
it's yeah, Boulder got the festival. So but I was able to go for a couple of seasons, and it's great. I think the creativity around filmmaking is fantastic and the people
It's
want to
definitely a scene, no doubt, that
yeah,
festival.
for sure.
Let's talk about AI. Well, you're bringing that talent to logs in terms of how streamline. How do you see AI playing a role in the near term for you personally in your firm? And should the paralegals all be worried?
I mean, looking broadly at AI, as in my prior practice at my prior firm, I saw so many clients come in with already baked contracts. It was clear that they're using the tool. They're trying to
Hmm.
figure out a way of reducing their cost,
Hmm.
and the different AI tools can definitely give an opinion of like here's a contract. It looks like it's going to be legit. It's going to work out. And then they get into negotiating it. They realized, oh, maybe we need an actual professional come in and make sure that this is the right set of terms that we need and help us with the red lines and the negotiation. I am a adopter. I'm an early adopter of all things technology. I formed the AI ethics committee at the firm Sagent when I was the chief legal officer there. They did core mortgage technology, worked on reseller agreements of AI related technology as it concerned portfolio movement. And the emerging law that I saw under the prior administration, I thought this might be a great place to anchor myself to and to practice in this. Privacy law is like a patchwork of laws in 20 plus states that are sometimes consistent, sometimes not. Surprisingly more consistent than like foreclosure law, for example. But I think the current administration is absolutely focused on not having AI at a state level. It doesn't make sense. The technology can't be regulated at a state level. But there are a lot of jobs that are subject to being reformed with the use of this technology. I view it as an associate, as good as a second year associate. Although the technology is advancing quite a bit, I worked with many legal AI tech providers to help iterate the tech, to understand it, to see how it can be implemented. I use it every day. As far as the firm is concerned, I think it's a great opportunity to have a built-in compliance, a double check, triple check, of the work that's being done. There's a lot that can be learned and insights that can be gained through the use of technology, through the use of AI technology over complicated lending scenarios. I see opportunity also in a flat fee environment where you can optimize and you can use the technology in the place of people in certain circumstances, but with the support of people. It'll allow for higher level thinking. There's a lot of clicking in mortgage and in residential mortgage servicing because of the antiquated nature of the platforms that core servicing technology is built on that has integrated into a more modern environment with limited exception. There is so much clicking and there's so many jobs that are really not fulfilling to humans. I think it's hard to get into mortgage servicing from a young professional standpoint. So what I am hoping to do and have been working on here in my 42 days at Logs is trying to figure out AI solutions to make these jobs more compliant and more fulfilling for younger professionals that want to get into this space. Mortgage and real estate and lending and enforcement are things that we do in the United States. AI can also help reduce our dependency on offshore resources, which a lot of firms have gotten into, a lot of servicers have gotten into the use of offshore resources. And that can be really great and really, really, risky, given what I know about information security. And so having AI support some of those functions can be great for sustainability for a practice. So looking forward into the future, 5 years from now, I think there's going to be jobs that are pivoted into how do we use AI? How do we monitor prompts? How do we monitor output? How are we looking at AI compliance versus the rote clicking that's necessary to do data transfers from one legacy system into, a law firm case management system?
And I'm probably pulling this out of I don't know what, but if I think about the world of debt that is coming due to everyday Americans, whether it's student loan debt, auto loan debt, credit card debt, mortgage debt, whatever debt that does whatever percentage goes difficult because somebody loses a job to AI or whatever. I would seem to think that the AI is going to have an impact across all brand servicing, etc., compliance, enforcement. But I think it would have even more where I could see it having more power is in the unsecured debt examples or the less secured, the stuff, maybe the replevins, the stuff that moves versus harder assets, which, I mean, it's all going to be helpful. I'm just thinking in terms of the impact that AI can have, certainly is data driven. And I think when you get into that kind of unsecured game, I think that's what that's about, but I could be wrong.
Yeah, I think it can be helpful, in analyzing portfolios and looking at where the risk lies. All forms of technology, can help make better decisions on what you purchase, what you decide to service, what you decide to liquidate. there's lots of different places from which data can be sourced to analyze any given scenario. Certainly, like from a law firm perspective, locating your counterparty and figuring out, or your defendant or your asset, like where does that asset lie? Additional data sources could be available that could help you find that a little bit better.
Hmm.
But the more data you have, the more there is to analyze, which is why AI is helpful, because it provides that analytics aspect where you could be inundated with so much data, not enough humans to digest it. But if you have AI doing a first pass, you might be able to at least cut it down into manageable chunks.
One thing that I always ask, people to do, which is predict the future. you know, um, Something feels on the precipice. My sense is that even if the federal government, the Fed, tries to lower interest rates internally, that the cost of all American debt is still going to either stay steady or go up. And I think that, for that reason, there's going to be something that cracks. That's just my sense. Do you have any guess as to what the next 6 to 12 to 2 months looks like? 2 years? Are you seeing like any cracks? Are you getting a little more calls from banks wanting to hire you guys? I don't know. Any
Yeah.
any any insight?
So we've seen, essentially because of the policy changes, increases in overall volumes, you know, things that needed to happen, in the early 2020s happening now that we're
Oh
in the
wow.
mid 20s, and just very delayed enforcement efforts. I think that we're seeing, more in terms of collections work, and the pressure to do that in the unsecured space. Absolutely. That unsecured space can impact the secured space. Big picture, I mean, I do think that through innovation, innovative technologies, the need to upskill and how newer businesses are entering the market and how they're deciding on hiring is going to result in the displacement of, some workers. And that is going to have an impact on debt, generally speaking.
Mm.
Our ability to pivot into different career, and to embrace what the new technologies are going to require in these, different startup businesses is kind of scary. And so that displacement, I follow Kathy Woods. I don't know if
No,
you're
of course, of course.
thoughts are, but every time I listen to her ARC updates, it's always amazing. She's definitely looking 5, 10, 20 years in the future with her innovative investment strategy. And I try to
Hmm.
read through her research and what she delivers as, what we're going to see from a displacement standpoint, because that's going to impact what we're dealing with in debt enforcement. So the iterative and the really fast nature of technology improvement is going to have an impact. That's what I predict.
That's well said. Oh, Wendy, it's been wonderful hanging out with you. Anything else to say about logs? Is Jason going to say, "Hey," or Lita's going to say, "Why didn't you say this?" Do you have anything else that you want to share with the world?
Um, so I think, Logs is in a really good position to help lenders at scale. I think we've got a really great flat fee environment, a group of operators who many folks here have been around in the space for 30 years, dedicated, loyal, real boots on the ground knowledge of how processes work at a granular level in any given jurisdiction, which is amazing. And with our tech initiative and our moving forward strategy from, enabling more tech, I think, we're a good choice out there. And if we're not the right choice, we'll let you know. We'll find another good choice for you.
That's right. Yeah, you
Yeah.
only have 30 of the 50 states. Well, I acknowledge you personally, Wendy, for always being on the cutting edge. And so I feel good I think it's a good sign that you came over to our side recently full time in the sense of you think this is where the money's coming. So we're all sitting here with our popcorn ready. And I am seeing double the amount of product to bid on, and so it's nice to know that there's the opportunity is going to get it should be healthy. And in the meantime, I love being a private equity buyer of debt. If I can be a liquidity provider, buy that debt at a discount, and then pass some of that savings along to borrowers by way of, forgiving, deficiencies and stuff like that. So, there's win-wins to it also. So that's
Absolutely. Absolutely. Your strategy of being very close to your assets too is unique and super beneficial for all parties. 100%.
congratulations on your new home and your new home. All your new homes.
Thanks so much, Bill. Thank you for having me. This has been a great way to spend time and love the debt doctor. Keep this thing rolling.
Let's do it. Thanks. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.